Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
Good evening, everyone. I want to just introduce Trey. We've known Trey for what's it been? A couple of years now, Trey.
It
Um,
has.
and in the multifamily space, as we've had people that have wanted to look at doing what we call agency debt, Fannie Freddie. We were introduced to Trey, and he's done a wonderful job in helping several of our clients out on the when it comes to the agency debt. And so what we kind of invited Trey to kind of speak about today is kind of help explain the difference between maybe agency and traditional lending, and then what the requirements are for somebody to be able to qualify to get agency debt, and then also with the new administration, kind of what he's seeing as far as rates, and again, not using the crystal ball, but kind of what do you think for the remainder of 2021, what that may look like. And from there, and Trey, you can tell us a little bit about, if you want to start off, tell us a little bit about your growing family there, and some of your background, because I know you have background in lending, not only just agency, but as a financial broker too, as far as lending. So you have a kind of a wide wealth of knowledge when it comes to lending. So
Yeah, no. Thanks, Brian. Thanks for the introduction. So, like Brian said, my name's Trey Palmedo. I'm with Lument, which is a legacy Hunt brand. We merged with Red Capital and Lancaster Pollard about it's been a quick year, about a year ago, and we formed Lument, which essentially what we are. We're a multifamily forward debt lender. We are a DUS lender for Fannie Mae and a Freddie Mac Optico lender. We're able to lend all of the products that both of those agencies have to offer, which is a little bit of a unique advantage that we have, because you have a lot of shops that can lend some products of the agencies, but we lend every single one they do. We also do HUD. We're the largest FHA lender in America, and we have a proprietary balance sheet that we lend off of, focusing mostly on multifamily bridge debt. I've been in the space now for 4 years, which is kind of crazy to think about. I've conducted I have a closing next week that will push me over $300 million in closed transactions for this space. And almost every single dollar has been in multifamily, and most of it has been with Fannie Mae and Freddie Mac. So as Brian mentioned, prior to being a direct lender for Fannie and Freddie with Lument, I was a mortgage broker. I brokered, again, with mostly a concentration on multifamily, but commercial real estate debt to fund commercial real estate assets. I did CMBS, life company, banks, a couple of hard money lenders, and then of course the two agencies. But I came on board with Lument, I guess, about 2 years ago, and when it was Hunt at the time, and actually the very first deal that I did with Lument is with Pat in this room. So so that's exciting. It's good to see. I think, and we can kind of launch into some of the questions that you asked, Brian. But from a high level, it's important to understand a couple of things about agency financing. The first is that post 2008, and I think right around the Dodd-Frank era, Fannie Mae and Freddie Mac, the two GSEs, were taken into conservatorship. So the United States federal government actually more or less regulates the entities pretty extensively. And when we talk about the changing administrations, under the Trump administration, there was a significant push to remove the agencies from their conservatorship. And I think a lot of the questions that we're asking ourselves right now is, does that push still exist? And it doesn't, there hasn't been a lot of signal from the current administration, but given where the administration's likely policies will line, it may be that the agencies are not moving out of conservatorship, which is interesting, and it'll have a direct effect. I think one of the most prevalent things right now, this is actually a pretty crazy number. Both agencies were given $70 billion for their cap for this year. And if you play around in the space, you'll know that's about 30 billion less for each agency. In January and February and March, they have already spent 30% of that money. So it is not going to last the full year. And come July, I think we'll see the strongest signal from what the Biden administration intends to do with the agencies on whether or not they recap them. Because if they do, then it's likely that will be an ongoing theme of the administration, and they'll continue the conservatorship. If they don't, then it may be that they're planning to take a step back. But I wish I had the crystal ball, but in this one, I think the 8 ball says that there will be some recap. They will get more money, and the agencies will continue on into conservatorship. But yeah, Jana, if you do you guys want to ask some questions? Or everybody who knows me knows that there's nothing I love to do more than talk. So I'm happy to keep talking.
But just if you could, Trey, just kind of go over what somebody has to do to qualify for the agency, and Fannie and Freddie are pretty particular. They don't, it's because of the fact that they hardly ever take any loans back. They're pretty particular on the front end. So if you can just kind of walk through kind of what it takes to qualify for agency for Fannie and Freddie.
Yeah, absolutely. I think one of the things that's really important to this discussion is to talk about some things to preempt qualifying metrics. The first is that Fannie and Freddie, the debt that we lend is called non-recourse debt, which for folks that are involved in the space is probably elementary material. But if you haven't been involved in the space, then non-recourse debt may sound a little unusual when I tell you what it is, because if you primarily work with banks, then this might sound too good to be true. So non-recourse financing is based on the idea that sans a few bad boy carve-outs, if you default on the property for, well, let's just say the property stops performing, we do not come after you personally and your personal balance sheet. We just take the property back. So it can be very attractive financing, number one, because you're not creating a contingent liability against your own personal balance sheet, which allows your net worth to more or less remain intact. And number two, the obvious, if the property goes belly under, then you don't lose your life's work. And then the second thing to note about Fannie Mae and Freddie Mac is that even though the agencies were designed to perpetuate the mission of affordable housing, I think it's no secret that they are very involved in the transactional space for all multifamily, and that they try very hard to win business, and they do so by being typically the best quote in the room. And I say that this is kind of how I describe my job, because at the end of the day, I work in sales, right? And if you work in sales, then you have competitors. But I say that, my competitors are not other lenders that are lending bank or CMBS or life company. The folks that, use that type of debt are not really agency wanting. Like the way that we lend, they usually don't want agency debt. Like if you're going to a life company, you're probably A-okay with the fact that they're only going to lend 60% loan to value. You're more than likely in a 1031 situation, or you're trying to clip a coupon. So, that's not, all that is to say, I don't go and compete with banks. If our type of financing, the kind of higher leverage, lots of IO, strong amortization rates, competitive interest rates, and active, transactional space. If that's what you want, then we're going to win from the agency perspective. It's going to be the best quote in the room, 9 times out of 10, 99 times out of 100, honestly. But where we do have a lot of competition is internally to our space. So, other desk lenders, other shops, it's a very competitive environment. So I wanted to notate those two things. First, that we have very attractive quotes, and number two, that all of our financing is non-recourse financing. To say this, because usually when we go through like what our quotes look like, everybody's like, I really want that, right? The challenge with the agencies is that because it's non-recourse and because we have the best quotes in the room, the agencies are very nuanced on what they're looking for inside a sponsorship for loans. There's really three main drivers: net worth, liquidity, and experience. And the first two are kind of easy. The net worth, we ask for a net worth to be equal to or greater than the value of the actual loan that we're making. And liquidity is post-close 9 months of debt service, although really, back of the envelope, 10% of the loan is typically, where that number comes in. Experience is the one that seems to be the ever-moving target of the agency world. And it's kind of a dead on arrival with Fannie Mae. They require 2 years of multifamily ownership experience of a like asset in a like market. So think, similar size. If you own, 12 units in, I'm going to, of course, like Dixon, Tennessee, they're probably not going to lend to you on your own to go do 300 units in Atlanta, Georgia. So we're kind of looking for a transitional type of experience, something that creates that wherewithal that they're looking for. With Freddie, there is a little bit of a discussion there. They still want ownership experience, but Fannie and Freddie, we kind of differ on how we interact with the agencies. With Fannie, we are much more involved and control a lot more of the process. Once we get what we call delegation back from us, sometimes we're delegated right out the bat. We can just lend the loan the way that the loan lies, and it's great. Delegation can be extremely useful because you pretty much have Lument on your team the whole way, and as long as we can stay within this box, then we make the loan. When we get non-delegated and go into what we call pre-review, which is very common, the deal gets overtook by Fannie Mae, and then they examine the deal and they give it back to us. That's when we get our delegation back. So more often than not, we have a little bit more of a control of the situation with Fannie, but we have to stay within their purview. With Freddie, it seems like a lot of things are an open discussion, but we don't really ever, we stand very limited on our delegation right off the bat. With Freddie, almost everything has to go in front of Freddie Mac, and they can look pretty intensively into deals, and if they there's been multiple times where I've disagreed with Freddie's, and I guess decision, but that's the that's the bucket that we play in there. So experience is a big driver, but it is important also to know that one singular individual does not have to have all three of these components. In fact, quite the opposite. Most of the transactions that I work with, because I work primarily in the acquisition space, is through partnerships of groups that have come in together and bring a variety of skill sets or a variety of qualifiers to the deal that get through the agency hurdles. So you may see things like, I can use a real life example. I have clients that have a very high net worth, but because they're super active in the acquisition space, their liquidity may not be as high, right? And so you have one guy that's got lots of cash, and you got another guy that has a ton of ton of experience, multiple agency borrower, and a strong net worth, right? So, you get that pair up a lot in this industry. And so I encourage folks that are trying to come into this, notwithstanding like you need to have some financial wherewithal, right? But I try and encourage folks that are trying to get into qualifying for agency debt to consider who's on their team. And when you consider who's on your team, then you have an opportunity to build something that can be very strong, trying to present to these agencies. So, the qualifying aspects is definitely a challenging part, but I think we try and get as creative as the agencies will allow us, and we try and offer solutions. It has always been my goal to call, when I call with a problem, to call with a solution as well. Anybody that's been involved in the commercial real estate space knows that these transactions are rarely without hiccup. There's always going to be challenges and obstacles, and it's a tough business. But what we try and do is we try and create a path that gets to close, and that's a big part of. I was having this conversation with one of the analysts that I work with, and he said, Trey, your job is to do the hard deal, because anybody can do a 55% loan to value, but when you're trying to go for max proceeds and max IO and the lowest rate possible and do it all for no origination fee, there's going to be hiccups, right? And so this job, and I think what we try and do a good job at is to take those challenges and hurdle them and get the loan to close.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.